The focus of this investigation is to compare purchasing two properties similar in value to determine the best value for money and comparing 4 home loans to establish the best suited loan to pay the least amount of interest. In determining which home is the best value for money, aspects such as land size, number of bedrooms, car park spaces, and appearance of the home overall were compared. When comparing home loans, the loan term, fortnightly repayments, interest rates, and total repayments were the major factors that were considered.
Our investigation was based upon the following scenario. A university student with a partner was looking to purchase their family home. They had already saved a $40,000 deposit and would like a house that includes a 3-bedroom property, a large open kitchen, large bathroom, backyard with grass area, cost $400,000 or less, and the loan terms were a variable rate over a 25-year time frame and fortnightly repayments. House 1 cost $390,000, had 3 bedrooms, 4 car parks, was 195 metres squared in house size, had a master bedroom with ensuite and walk-in robe, a laundry, a large open kitchen, large family room, and an alfresco area with grass and paved area. House 2 cost $389,000, was 3 bedrooms, 2 bathrooms, included 1 car park, was a 2-storey home, 166 square metres, has a master bedroom with ensuite and walk-in robe, a laundry, large kitchen, and large living area. We chose to compare 4 financial institutes: Bank SA, People's Choice, Commonwealth Bank, and NAB. After comparing different loans, it was determined that the Commonwealth Bank would have the least amount of interest paid overall for House 1, with $234,779 being paid in interest. This was a savings of between $111,703 contrasted to Bank SA, and a savings of $33,595 from the NAB. After comparing the different loans for House 2, it was determined that the Commonwealth Bank would have the least amount of interest paid overall, with a savings of between $86,903 from Bank SA to $29,310 from the NAB. We came to the conclusion that House 1 using the Commonwealth Bank would achieve the best value for money and the least amount of interest paid. We came to this conclusion by comparing the land and house size of the 2 properties. House 1 was considerably larger for only $1,000 more, which is quite a bargain.
The investigation was planned thinking mathematically by setting an initial figure for a pre-save deposit, $50,000, and then a constraint was placed on the price of the house that would be no higher than $400,000. We worked mathematically by keeping our budget in mind when searching for a house. We used our knowledge of geometry to compare the space land size of the house and used our knowledge of money, interest rates, percentages, and time to compare the best loan.
This investigation required us to use several areas of mathematics to conduct it. Financial mathematics was used when calculating the amount of interest that would be accumulated on a home loan. Real numbers were used when comparing the effects of interest rates on home loans from different financial institutes. Measurement and geometry was used when comparing the home and land size of the properties, and data handling was used when exploring the different opportunities and loans provided from the financial institutes. A loan can be defined as a thing that is borrowed, especially a sum of money that is expected to be paid back with interest. Borrowers can take out a loan for $84,000, for example. The concept of loans extends back into the early ages of time and is second nature to humans. Reams of historical information date back thousands of years, show the evolution of the loans. The earliest records of loans backdate to the Babylonians and Egyptians, who were merchants of trading produce. Then there was the Romans and Greeks, who had a long history of the lending industry until the introduction of interest loans from the Mesopotamians, until loans finally reached the European civilizations during the 13th century. Loans have progressed over time of their existence, from indentured loans to the current loans, which can be secured or unsecured, concession or demand loans. Indentured loans were common during the Middle Ages through to the 1800s in Europe. The indentured loan enabled gentry and rich tradesmen to borrow the money for the purchase of house or land. In return for the finance, the borrower was expected to repay their debt by working on a lender's estate. It was common for exploitive lenders to overinflate the debt or interest payments, which forced the borrower into becoming a slave. The indentured loan progressed to banking loans after the early Italian pioneers began setting up stalls in local markets from which they lent out money. An interest rate was applied to the amount of money being borrowed, and the borrower was then expected to repay outstanding money at set intervals in time. The main issue with the first bank loans was the diverse variation in the interest rates on loans, as the central authority did not control the rate. Instead, the rate was decided on by each lender. A few hundred years later, money lending became subject to far greater control, with most countries issuing loans from money lenders controlled by central banks or financial authorities. A control was also introduced to the amount of money an individual could borrow. Prior to modern banking loans being introduced, people were able to borrow as much money as they wanted to, which led to some serious issues with servicing huge debts. Today, there are four primary types of loans you can take out. Secured loans, which use an asset as collateral, usually a car, a house, or anything the bank sees as sufficient to service the debt if failure to meet repayments occurs. Then there are unsecured loans, which do not use assets to secure the loan and typically have a higher interest rate instead. Unsecured loans are common on credit cards, personal loans, bonds, and overdrafts. Demand loans can be secured but are generally offered as unsecured loans with no fixed repayments and varied interest rates. These loans are named as the lender can ask for a repayment at any time. Concessional loans have an interest rate applied which is usually below the market standard. These loans are commonly used by the government to loan to poorer countries, but may also be used for employee benefits from a financial organisation.
The demands of numeracy within society have dramatically changed over time and will continue to do so as society changes. Being numerate is no longer defined as having a basic competency in mathematics. Instead, the meaning has advanced. To be numerate is to use mathematics effectively to meet the general demands of life at home, in paid work, and for participation in community and civil life. Scott believes the essential ingredients to being a numerate individual are content, confidence, and context. To be considered a numerate person, you must understand the specific content of the task at hand. For this comparison, understanding percentages, money value, time, interest, and also understanding material values are vital to understanding the content. For example, the new potential homeowners will need to be able to estimate and determine whether the price of their house is worth the $400,000, or if the second option is better value. Being confident in knowing what type of mathematics is needed. For example, it was known that if the percentage was higher, interest, assuming the starting prices are both the same, the overall amount would also be higher. In this case, the starting prices were both different and the comparison required more calculating. Confidence was then needed to accurately use basic addition and subtraction to compare the more suitable loan and therefore more affordable house. Context is the third requirement to being a numerate person. To accurately compare the two houses and then home loans, the potential homeowners need to understand the language of loans which relate to knowing financial mathematics. You must know the value of land size, room sizes, and features of a house to be able to compare the two houses and select the most appropriate and affordable to their specific lifestyle. This investigation required us to take multiple steps of personal action. We accessed multiple real estate websites searching for the most appropriate houses to compare and took our own personal circumstances into consideration to find the house that was best value for money and that provided the opportunity for the expansion of a family. We were also required to look at the loan terms of multiple loans and compare these among different banks to determine the best financial lender, rather than choosing a loan based on the banking services we already use.
This investigation has developed our mathematical learning in the area of financial mathematics substantially. By investigating the costs in purchasing a home, we have discovered that there are many fees and charges involved once an initial deposit has been saved. By accessing digital technologies such as a home loan repayment calculator and stamp duty calculator, we have achieved a considerable amount of new knowledge about the added costs in purchasing a home and the types of loans that are best suited for paying a lower amount of interest over a set period of time.